Hello and welcome to our mini webinar on charitable contributions. My name is Steve Boisvert and I'm a CPA with Gelman, Rosenberg Freedman. We're going to focus on the main changes made to the charitable contributions in the Tax Cuts and Jobs Act, and then we're going to move on to some tax planning opportunities you can consider when contemplating when and how to make charitable contributions. This webinar is part 4 of a 5-part series on changes to itemized deductions, and we've already discussed medical deductions, state and local tax deductions, and mortgage interest deductions in parts 1 through 3. The 5th part, after part 4 of charitable contributions, the 5th part will discuss changes to the casualty loss deduction and deductions on 2% AGI floor, namely the employee business deductions. So then now that I've said deductions about 20 times in the first slide here, let's get started. So this first slide here is simply a breakout of the 2018 draft Schedule A. This section of the draft Schedule A is for gifts to charity, and there's really no change to this. The calculation's always been very simple. You take your cash contributions plus your non-cash contributions, and the total will end up on line 14, which then goes to schedule or page 2 of your 1040. So as long as we have no extensions to the Act in 2025 or before, these rules will end in 2025. And really the most notable change to the charitable contributions rules have to do with the AGI limitation. Now, if you've watched the previous 3 webinars, you're probably sick of me telling you about AGI floors and limitations and thresholds. Well, don't hate me, hate the writers of the tax code. Once again, we have an AGI limitation, which under the old law, your cash contributions to charities was limited to 50% of adjusted gross income. Now, under the new law, the AGI limitation for cash contributions to charities is 60% of adjusted gross income. So we've gone up 10%. And the question is, will this affect you? I mean, it's a good question. The situation where we see this most is with high net worth individuals whose net worth is high, but they may have a down year from an income perspective. So the market may be performing poorly, they don't have as many dividends and interest or capital gains, and they are still making very large charitable contributions. You know, maybe they're trying to just reduce the size of their taxable estate by contributing to charity. You know, who knows what the situation is, but that would be a likely scenario. So, do you lose the charitable contribution over 60% of AGI? No, it's carried over to the following year. And I'll run you through an example to show you how the charitable contribution limitation works. Most taxpayers will not be affected by this. The new law does require substantiation of contributions over $250. Charitable organizations will need to provide the letters to donors. So let's do an example of the old rules followed by the new rules so you can see the difference. In our example, we have a taxpayer with adjusted gross income of $100,000 and charitable contributions of $70,000. So under the old rules, the AGI limitation on $100,000 was 50%, and that would be $50,000. Charitable contributions for 2017 were $70,000. We subtract from $70,000 $50,000, and you will carry forward to 2018 $20,000 of charitable contributions. So you haven't lost these. You're simply not getting the deduction in 2017, of $70,000. You're getting a $50,000 deduction in 2017, and in 2018 you're getting a $20,000 deduction providing your adjusted gross income is higher than $40,000. Because if we took 20,000 times or divided by 50%, that would equal 40,000. Now, if we apply the new law in this scenario, our AGI limitation is now 60%. So you've probably worked out the math already. But if you take 100,000 times 60%, that's a $60,000 max deduction for 2018. And your total charitable contributions were $70,000. So if we say 70,000 minus 60,000, the answer is you have a carry forward of $10,000 to 2019. As long as your AGI is over, what is that, $25,000 or something in that range, you should be able to get this full, no, it would go the other way. As long as your AGI is somewhere over $18,000, you would get the full $10,000 deduction in 2019. Let's get down to a few of the tax planning opportunities that we have with charitable contributions. And the first category that I want to get into is donor advised funds. Now, this is a very interesting area, but there are some potential traps for the unwary, so you really have to be cautious as you pursue this particular planning opportunity and technique. Of the major brokerages, I know that Vanguard, Fidelity, and Charles Schwab all offer donor advised funds, and there are likely a bunch more out there, but you definitely want to go with a donor advised fund that has been vetted and is going to comply with all the IRS requirements to make it legitimate. You don't want to make a large contribution to an organization or a fund that hasn't crossed all their T's and dotted all their I's, because you may be thinking, hey, I'm making this charitable contribution, I'm going to have a nice tax deduction, and then boom, it gets challenged by the IRS. The organization missed some things and you don't get a contribution. It'd be a big waste of money and you don't get the tax benefit. So just some quick notes on donor advised funds. They do not give the donor full control. It's not a donor controlled fund. It's a donor advised fund. Fees are low in comparison to private foundations and supporting organizations. But once the contribution is made to the donor advised fund, i.e. like Fidelity Charitable, the donor can advise where they would like the money to be used, but they have no control over that money. They have no control over the funds once contributed. So as the name implies, the donors have advisory power, but not true power. So that's definitely something you need to be aware of. So advisory. The second point you need to be aware of is that the deduction limits are the same as a typical public charity. So the AGI limitations of 50% or 30% for a capital gain, or 60% for cash contributions, which we discussed in the earlier section of this lecture, all apply the same as they would for a regular charity. And the third point, this is really the key point to a donor advised fund. Say you are charitably minded, but you have not determined what your charitable goal is. Well, providing you use a reputable donor advised fund, you can get the immediate tax deduction in the year of contribution. And the donor advised fund will allow you to determine which charities you'd like to support afterward. You are the advisor, though. You don't control the funds, as we talked about in point 1. So if I were to make up a quick example, say I bought $25,000 worth of Apple stock a couple years ago, and now my Apple stock is worth $50,000. It's a long-term capital gain. I contribute that stock to a donor-advised fund in the current tax year, and I advise the fund, I'd like to make $5,000 contribution to the Red Cross and another $10,000 to the University of Maryland. But I really don't know what I want to do with the other $35,000. Well, it just sits in the fund until you're ready to advise where you would like them to make that money contributed to. So that's some quick points on donor advised funds. If you have more questions on those, definitely reach out to us. There are definitely some pitfalls that you need to be careful that you don't fall into. One last point that I wanted to bring up regarding donor advised funds is that you normally see a donor advised fund in a year where there's going to be a big tax hit for something. So you have a lot of capital gains that you're harvesting in that one year, and you end up with a big tax hit while you're trying to shelter some of that tax hit. You make large charitable contributions, but you're not sure where you want to contribute all the money to yet. Or maybe you sell your business and you're trying to shelter some of that. Those would be some different scenarios where you may use a donor advised fund. Moving on now, let's look at this tax planning technique called contributing appreciated stock as opposed to cash. So appreciated stock, and we're really going to focus on long-term capital gains. You can contribute things other than long-term capital gains, like a short-term capital gain. Long-term capital gain is a stock held for more than 1 year. But there are additional laws that come into play. If you're thinking about contributing a short-term capital stock, short-term capital gain, reach out to us and we can walk you through that. For purposes of this example, we're just going to talk about long-term capital gains. So if we go back to our previous example where we had the sale of Apple stock, let's say that our capital gain on this stock is now $50,000. Maybe the basis in the stock was $50,000 and we sold it for $100,000. So we've got a long-term capital gain here of $50,000. I've set up our example a little differently than a tax return would show it. I've got wages here of $500,000, capital gain of $50,000. Our AGI is $550,000, and then we have a charitable contribution of $50,000. So our taxable income at the end of the day is going to be $500,000, and we apply a tax rate. Now, I've just done, for simplicity's sake, a long-term capital gain tax rate of 15%. If you're in the top tax bracket, it's going to be 20%. And then there's also the net investment income tax of 3.8%. So you could be paying a top tax rate on that long-term capital gain of 23.8%. So I have, for simplicity, just used the 15% tax rate here. But if you are in the top tax rate of 37%, you will be hit with a higher long-term capital gain, which in this particular example would actually save you more money. You'll see the tax saving benefit of this more if you're going to be hit with a higher capital gains rate. So in this situation, this particular taxpayer cashed out the stock and then turned right around and contributed money to his favorite charity. Well, instead of doing this two-step process, I would suggest layering these two different tax laws on top of each other and getting a better tax benefit. So how I would set this up, instead of cashing out the capital gain, I would just contribute that stock. And what you do when you contribute the stock is it is limited to a 30% AGI threshold. But as we learned in previous slides, you don't actually lose the capital or the charitable contribution. If it's limited in any way, it's just going to be carried forward to the next year. So if we run this through to conclusion, at the end of the day, you're simply not paying tax on the charitable contribution or on the capital gain. So you're saving yourself at least $7,500 in this scenario. But what you've really done here is you've reduced your tax, like I said, by $7,500. So same result, just instead of cashing out and then contributing to charity, just contribute the stock to the charity. And again, you got to be aware this is for long-term capital gains in particular, any kind of stock held for more than 1 year. But you can see the tax benefit here. You've paid less by $7,500 in this scenario. But if we were going with a 23.8% tax rate here, you know, I mean, what is that? That's almost another $4,000. 11.5. I mean, if we're going, the higher this gets, the higher the charitable contribution is. This is really a valuable tax planning technique that you should be thinking about when you're making your charitable contributions at the end of the year this year. Our final tax planning technique, and I'm not going to spend all that much time on this one, but it's the idea of front-loading your charitable contributions. So in tax year 2018, we have the taxpayer paying state income tax of $10,000, mortgage interest of $10,000, charitable contributions of $10,000 for a total of $30,000. In 2019, they're doing the same thing. The standard deduction is $24,000. So their itemized deductions are only $6,000 higher than their standard deduction. What if instead of doing these two charitable contributions in 2 different years, say you're making this contribution at 12/31/18 and you're making this one at 1/5/19, well, why don't you just make this one over here? So you have $40,000 of charitable contribution or of itemized deductions in year 2018, 20,000 in 2019. In 2019, because your itemized deductions are lower than your standard deduction by $4,000, you're getting an extra $4,000 benefit in 2019. Now, I got to be honest with you, I've run different scenarios with this particular projection, and where you do come out ahead on the federal tax return, you may end up owing more tax on the state tax return. So sometimes these net out to very little tax benefit. It really depends on your state income tax laws and how much their standard deduction is. So don't just assume, oh, this tax planning technique will net me $2,000 a year or whatever. It's something to keep in mind, and if you'd like us to run projections for you on this type of transaction, we can talk about it and see if it makes sense for you. So that's all we have time for today with our charitable contributions. As always, if you have any questions, please reach out to me. My email address is sboisvert@grfcpa.com. You can reach me directly at 671 if you call the firm's phone number. And you can follow us on any of our social networking sites. We talked about a lot today, and there's definitely a lot more we could get into. We didn't even talk about topics like conservation easements or charitable lead trusts or charitable remainder annuity trusts. There's a lot of different techniques you can use in charitable contribution planning tax planning. And, we'd love to talk to you about those things. So please reach out to us, and thanks again for listening today.